What's up, family? Andre here. Over the last several months, there's been a lot of talk about investing, specifically in the stock market, Robinhood, GameStop, AMC, and all the above. But there's one critical aspect that many people need to be aware of, especially in a market that has been as very successful as this one has. And that would be capital gains tax. Today's episode is all about capital gains tax, what it is, the details around the proposed changes to the capital gains tax, and how that could impact you and your money. But first, before we get started, to continue to help with the YouTube algorithm, please don't forget to smash that like button, hit the subscriber button, as well as the bell next to it to get updated weekly content. It's expected and understandable that it is difficult to pick the right stock and the right mutual fund, let alone being worried about after-tax returns. But these are some of the consequences that many people, especially day traders, are now running into, and that is the capital gains that are now being assessed to their portfolio. It is just as important in figuring out the tax consequences of your strategy, including timing when to buy and sell, to be able to understand the overall investment in your total portfolio. So let's begin first. What is capital gains? A capital gain is when you sell an asset, in this case a stock, for more than the original purchase price. In a similar fashion as the United States government wants a portion of your income as you earn that income, they also want a portion of the investment where you have realized a gain. That is called the capital gains tax. It's important to understand the two categories of gains: unrealized gain and realized gain. An unrealized gain is that you have a particular asset, in this case a stock, that is in your portfolio and has a potential profit on it, but you have yet to execute the transaction that will now allow the profit to be put into your account. On paper, it says that you have profited or that there's a gain on that particular stock. But until you actually sell that investment asset, you have not realized that gain. A realized gain is the exact opposite of an unrealized gain. You have the same investment asset, in this case a particular stock, and you actually do sell it. The profits that come from that sale that now is in your investment portfolio is a realized gain, and thus a capital gains tax will be forthcoming. Capital gains apply to what is known as capital assets. Here are a sample of what are capital assets: stocks, bonds, jewelry, your home, your vehicle, collectibles. The Tax Cut and Jobs Act of 2017 excluded a number of categories from the capital gains process. That would include patents, inventions, models, and other designs are now out of the category where they can be potentially taxed for capital gains. In addition to the categories in terms of capital assets, your capital gains tax is also influenced by the duration of how long you have held a particular asset. You have two categories: short-term capital gains and long-term capital gain. In theory, the longer that you hold an asset, the better favorable treatment you're going to get in terms of capital gains. If you hold an asset for less than 1 year, it will be considered a short-term capital gain when you sell that particular asset. And because of that short duration, typically those gains are taxed at the ordinary income rate of the particular individual and not at the capital gains tax rate. When you hold that asset for longer than a year or more, you now fall into the category of potentially being taxed in the capital gains tax rate instead of the ordinary income rate. For 2021, the current capital gains tax rates are 0, 15%, and 20%. Keep in mind that these are subject to change as the new Biden administration has made several proposals to marginal income tax rates as well as to capital gains tax rates. Keep in mind there are still some subtle differences based upon particular asset categories. For instance, gains on collectibles, such as artworks or stamp collections, are currently being taxed at the 28% tax rate. The current tax on a gain on the sale of a qualified small business stock is currently taxed at the 28% tax rate. The gain on the sale of real property, where depreciation has already been taken, is called the unrecaptured Section 1250 is taxed at the maximum tax rate of 25%. It has also been mentioned that there is capital gains on the selling of your primary residence, but there are also some qualifiers on that particular category as well. The first $250,000 of the gain of the sale of that primary residence is excluded from the individual seller if that seller has lived in that primary residence for 2 years or more. For married couples, the same qualifier applies, but now that $250,000 is doubled to $500,000. In addition, some investors are subject to the net investment income tax based upon their capital gains and what their modified adjusted gross income is. You would be subject to net investment income tax if your modified adjusted gross income is greater than $250,000 for married filing jointly, $200,000 if single or head of household, $125,000 if you are married filing single, $125,000 if you are married filing separately. Prior to 2018, the basic capital gains calculation was based upon your taxable income. If you fell into the two lowest income brackets, your taxable capital gains rate was 0 and you owed no capital gains on any of your investment income. The Tax Cuts and Jobs Act of 2017 changed that calculation to have capital gains tax rates align more with taxable income and not be focused on tax brackets. There are several ways that you can minimize or even eliminate your capital gains tax. Here are some of the ways that you can focus on minimizing that capital gains exposure. Investing for the long term. As I mentioned earlier, the longer that you hold a particular asset, the better favorability in terms of capital gains tax are there on that asset. So finding and doing your research on great companies that you can invest for the long term helps you be able to minimize or even avoid capital gains tax. Tax deferred retirement plans. If you're able to invest your investment portfolio in retirement plans that have tax deferred status, such as 401ks, 403bs, or IRAs, you can be able to invest and grow your portfolio without the subject of immediate taxation. You can buy and sell within those particular plans without triggering any immediate capital gains tax treatment. But keep in mind that when you begin to access your tax deferred retirement accounts in retirement and begin to take distributions, you will be taxed at whatever the ordinary income tax rates are at the time of your distribution. That is different within the IRA category. Traditional IRAs would be taxed upon distribution at ordinary income tax rates. However, Roth IRAs will not be taxed because it's able to be invested and grow tax-free, and distributions from those Roth IRAs are not subject to any type of tax treatment. It is not just capital gains that can be strategically deployed to be able to have an impact on your income. You can be able to use capital losses as well to be able to offset some of those capital gains and be able to net down your taxable exposure as much as possible. For example, if you own two stocks and say one is up 20% and the other one is down 10%, you could be able to sell both stocks and realize the gain on the 20% stock and then use the 10% lost stock to be able to offset that gain and then reduce your taxable income exposure. If you have a capital loss that can be used to offset the capital gain for a particular year, you can use up to $3,000 to offset ordinary income for that particular year. Duration of time of how long you hold a particular asset has a great impact on how you can reduce or minimize your capital gains exposure. Assets that are sold in 1 year or less are subject to ordinary income tax. Assets that are held longer than that now fall into the capital gains tax, which are currently 0, 15, and 20%. Understanding your cost basis. When you purchase shares in a company or a mutual fund at different price points at different times, it's important to understand the cost basis of the total exposure that you have in that particular company or mutual fund. There are 5 ways to be able to determine your cost basis for the shares that you want to sell. There is FIFO, first in, first out. Then there's LIFO, last in, first out, dollar value LIFO. Average cost, this is only for mutual fund shares. Specific share identification. Here are a few of the key takeaways regarding capital gains tax. A capital gain occurs when you sell an asset for more than you paid for it. If you hold an investment for longer than a year and sell that investment, it is now considered a long-term capital gains and subject to a significantly lower rate than if it was a short-term capital gain. Key strategies to be able to minimize or even eliminate capital gains tax include investing for the long term, being able to invest through tax-deferred retirement plans, and using capital losses to offset capital gains. It's also important to be able to consult with a tax advisor if you have substantial investments within your portfolio to understand the strategy around selling and cycling out or buying into particular stocks, mutual funds, or companies so that you can minimize or even eliminate your tax exposure. Taxes certainly are not the most exciting part of an investment portfolio that investors want to talk about, but it probably is the most important because it can have a significant impact on the success or failure of that particular investment portfolio. It should be a part of your overall strategy, not necessarily the foremost part of your strategy, but certainly a part of the overall strategy of how you are able to cycle in and out of these particular companies to be able to minimize your tax exposure. It's important to be aware of any proposed changes or regulations that can impact your capital gains exposure. New administrations come in with new plans, and different parties have different strategies around capital gains. In terms of your investment portfolio, in order for you to stay on course for your goals, it is important to have a capital gains strategy as well as an investment strategy. And that is it. Hopefully now you have a better understanding of capital gains, how they're calculated, how they can impact your overall investment portfolio, and ways that you can be able to minimize and avoid that to have an impact on you and your money. But before you go, to help with that algorithm, I need you to smash that like button, hit the subscriber button, as well as the bell next to it to get updated weekly content. Thank you for tuning in.